Welcome to our Schedule C versus S Corp. Um, in this course, we're going to analyze the difference between a Schedule C and an S Corp. We at tax preparers are asked that question a lot. Should I incorporate? Should I become an S Corp? And often people who are inexperienced will say a yes, as if that is an answer that fits all without really analyzing each client's unique situation. So this is going to be a brief course as I've been struggling uploading really longer videos, so hang in there with me. The spreadsheet will be for sale. If you are interested in getting the spreadsheet, you can just click on the link below, and it's on Podia.com, and you can purchase it there. I did have a CPA/Excel expert help me with the spreadsheet. So he helped me create it. It cost me a lot of money. So please understand if I'm selling it now. I'm just trying to recover some of the hourly cost that I paid for someone to review it and to help me design it and make it better. I did have one before that, and that's here on a tab called Original Template. But as you can see, there was a lot of plus and minus going on everywhere, and I think it was hard for clients to follow the numbers sometimes. So I actually like the new design much better because I think it's simpler to explain. So let's dive into it and run some different scenarios. So the first tab where you're going to start working, you can start either on the home office one by entering the client home office expenses. And most of you are familiar with that. And the reason why I like to explain this to clients is to also understand that as an S Corp, they're not allowed to depreciate their home. So that's a deduction they lose when they become an S Corp, the depreciation of their home, if they work from home and they have a home office. So it's important to understand those distinctions. Also, the safe harbor method, it's only available to Schedule C filers. It's not available to an S Corp owner. So that's something also to think about when incorporating. So I'm not going to spend much time on this one. Again, most of you are aware of how the home office deduction works. But what I do wanted to say is that you do need to enter something here. If there's no numbers here, the formulas don't work on the next tab. So if you're going to use this spreadsheet to analyze a client who doesn't have a home office, then you might have to come here on the line for the home office and force entry a number, $1 or something, or make the home office really minimum that it won't really have an impact. But you do have to have numbers there for all the formulas to work and for everything to flow, because everything flows from one tab to the other. So it's important that every tab has some numbers in it for the formulas to work. Okay. So I usually start on the business tax return analysis of the client, and I ask them, I usually pull up their last Schedule C filed, or we look at a projection of income that they're going to have for this year. And there we enter their gross sales, their cost of goods sold, and their typical business expenses. So basically the first column here for the book basis often looks just like the second column for the Schedule C. Then we talked about what reasonable wages are, and we do some research and we put that number in there. So basically any number in blue, you're going to have to enter it. The black's a formula, so don't touch that. They are all protected, so I don't think you can touch it even if you wanted to, but just letting you know all the black are formulas, and all those cells have been protected. So that's what I paid that CPA so much money to do for me, so they're safe. Then the next thing you need to enter, and that's going to vary based on your firm or based on your region, what would be the additional tax preparation cost, the difference between a Schedule C and an S Corp. I mean, it could vary. It could be a couple $100, it could be $500, it could be $1,000. Over here at our firm, the difference is about $400. So I'm going to change it from $1,000 to $400. But again, this will vary. Next question is payroll processing cost. If this client already has employees, then there is no additional payroll processing cost necessarily, except for maybe the direct deposit fees, which is minimum. So It'll depend, but I'm going to assume most of the people are self-employed with no employees, and they're considering becoming an S Corp, so that would be an additional cost to them. The unemployment will also vary. Some states let the S Corp owner opt out of state unemployment, because really, what are they going to do? Fire themselves? So this will vary again based on your state rules. I'm not a payroll specialist, so talk to a payroll specialist in your area. But again, this number is not huge, so it's not going to make a big difference. Next one is additional state minimum tax. In the state of Vermont, where I'm located, the corporate returns pay a minimum tax of $250. I know California might be like $950. Depends on the state. Maybe some states even have a zero, I heard. Again, you have to check with your state and find out what the state minimum corporate tax is. So those are the numbers you're going to have to enter. And then I explain to the clients how their tax return, the business side of it, will look under one scenario versus the other scenario. So as you can tell, in this scenario, the taxable net income as an S Corp will be a lot less because the owner now have wages. So I explained that to the client. I also explained to the client that the employer taxes on those owners' wages is an additional expense as well for the S Corp. But as you guys know, self-employed individuals filing Schedule C also get a deduction for half of the self-employment tax as an adjustment to income. So it's not necessarily something new to this client, if any, but I just try to explain to them how those two different tax returns will look like and look different and why. Okay, next that business tax return will flow to the personal return. The Schedule C is a schedule that's part of the 1040, and the S Corp return will create a K1 that will then flow to that individual client's tax return. So then that's where we do our final analysis. So here I have again the Schedule C 1040 and the S Corp owners 1040. I'm assuming single client here just for the sake of simplicities, and then I explain to them how it's going to look different. An S Corp will have wages and will have a K1, Schedule E, page 2 from the S Corp. A Schedule C, assuming no other income, will have just Schedule C income here. So I just explained to them, and then I walk through the steps down the line. I explain to them, hey, as a Schedule C, you would get a deduction for half of the self-employment tax, but now as an S Corp client, the S Corp already got that deduction on their return. Then we keep going down, explaining differences to the client. I also explain to them their QBI will be a lot less, because QBI for Schedule C person is based on their Schedule C income, and for an S Corp owner is based on the net profit of the S Corp, but not based on the wages. Wages from an S Corp owner don't count towards QBI. So I explained to them how their QBI deduction will be a lot less. So in this case here will be $8,540 less. So what that means for this client is the actual taxable income is higher as an S Corp than it is as a Schedule C filer because of QBI. And also because this client is now paying less self-employment tax, so he has less of a deduction for the half of that. So I explained to the client that means they might be on a higher federal income tax rate, and they might pay more federal and state income tax. So then I explained to them, if there was no estimated tax paid, this is what the total tax would look like on their 1040, and this is what would look like on their 1040 if they were an S Corp. So it might sound really good if you're only looking at this difference right here and be like, wow, let's become an S Corp. I'm going to save, $16,000. It sounds great, but that's not everything that happened behind the scenes. So I like to look at the cash flow analysis and then explain to the client, wait, let's look at the whole cash flow analysis. There was additional state income tax that this client now paid because the higher taxable income. Again, if your state has zero tax, then you can take this number out. And there's also this client paid Social Security, Medicare as an employee and as the employer. So that was an additional expense as well that happened behind the scenes. And then there's additional tax preparation fees, additional payroll processing fees, additional state unemployment, and the additional state minimum tax franchise fee. So the actual tax savings for this client was $5,484. So not the $16,687 that some tax preparers just tell the client, that's what you're going to save, do it. And then the client doesn't really understand all the other things that are happening behind the scenes and what the actual cash flow tax savings is. So you might say, hey, great, this client should do it. $5,400 is no joke. It's good money. Yeah, I agree. But I have another template here that I created, and it's called To Discuss with Client. So go over this with your client. There's pros and cons here. Not everything is as black and white as we think. If this client is AGI sensitive, this could affect FAFSA, it could affect Medicare courses. This client is now contributing less to Social Security benefits. There's a lot of pros and cons. So go over in detail with your client so the client can truly understand the up and downs of becoming an S Corp, and then make an educated decision. Okay, I hope this course helped you guys. I know it's brief and I had to go fast, but feel free to post any questions below, and when I have time, maybe after tax season is over, I'll be happy to reply.